Can I ask you to do something a little challenging? We just went through a whirlwind of a month to end Q1. Summarize top 3 things that occurred.
Top 3 things: bank crisis and bank run with SVB, the Fed coming in and backstopping many depositors, and then ultimately tech stocks ripping to year-to-date highs.
Let's start with tech stocks. It seems like there's this tug of war between these are the technology generals, Apple, Facebook, Google. They all of a sudden have this new tech tailwind called artificial intelligence or generative AI. And then the other side of the continuum, markets are seeing a slightly overheated sector with earnings fundamentals not necessarily keeping up with how much the hype is. Where do we shake out on that continuum?
I'm a believer that people tend to overestimate the impact technology is going to have in the short term and underestimate in the long term. And I think we're seeing that play out today. So to answer your question, I'm more worried about the fundamentals in light of technicals being so rosy. I think AI could actually be quite the existential threat to these businesses, not to mention fundamental earnings concerns they could have if we do have a hard landing later this year. And so for that reason, against basically these stocks at all-time highs, I think it's worth being a little bit cautious. So we are underweight these stocks. We're long, but relatively underweight compared to if you just were to go out and buy the next one.
And let's take almost like a double click on Microsoft. I think I saw this data, which I was unaware of. I knew Microsoft had a minority investment in OpenAI and hence ChatGPT, was unaware they owned 49% of the company, which might go down, eventually as one of the best deals of all time. That's a good case study for what's going on with technologies and these generals. So how do you think about Microsoft specific positioning?
I think they're easily the best positioned of the mega cap tech giants. One, because of the relationship with OpenAI and how well they've leveraged that. Their ability to quote unquote commoditize their complements is like classic strategic game theory. They've obviously did it with products like Microsoft Teams, far away, bypassing Slack's user growth and user base scale there. So I think Microsoft is the clear leader and the clear winner. That's not to say that others like Apple and Amazon and Google can't compete, but I think they're playing with one arm tied behind the back at this point.
And the thing, I know when we chat with other CEOs, a lot of the biggest commentary is just around landmines in the economy. There's a lot of different low probability things the world might step on that could just cause an eruption in the markets in a brief period of time. What are sort of the 1 to 2 things our investment management team is looking around the corner to see if that's the thing that's going to strike?
Inflation is still the most important thing. Liquidity is what moves markets in the short and medium term, and liquidity is going to be a function of the cost of capital, the Fed funds rate. So people think it's a foregone conclusion that rates have effectively peaked and that Fed's going to massively cut later this year, and that's going to be a huge tailwind for duration. You should go out and buy tech stocks. We're skeptical. We think inflation will be stickier, whether it's because of China reopening and demand growth, whether it's because of commodity prices reflation, crude oil positioning is super bearish, which could be fuel for a massive short squeeze.
And you want to connect the dots. So yeah. I know a lot of our clients probably read all the headlines about inflation, but then the so what? It's okay, prices are increasing and the economy's overheated. So why then does that have possible landmine implications for a lot of the things that we're talking about?
Yeah, if inflation, it's all about expectations. So if inflation is higher than people expect, that implies the Fed's going to need to keep interest rates higher for longer, which means the discount rate you need to apply to the stocks you want to own is higher, which means fundamentally they should be valued lower. So multiples will compress. So a stock that you liked at 20 times earnings, if inflation is going to grow or stay high for a foreseeable period of time, you should probably be only willing to pay 15, 17 times earnings. And you should expect multiple compression. So people should be worried about the stocks they own if we're in a higher for longer environment, assuming those stocks are priced as if we're not.
I think probably a good place to wrap up with just financial theory. Let's do it. We can talk more artificial intelligence next time.